What many business owners don't understand is that the tax system works in layers. The company pays tax on its profits, and when you take out money again personally, you will pay tax at that point again. Now, this part isn't necessarily the issue. This is just how the system works. The issue is that a lot of business owners end up paying more tax than they need to just because they don't understand the order in which they should pay for things and the order in which money should leave their business. What usually happens is something like this. Money comes out of your company and you pay your personal tax, and then your life happens. You'll pay for your phone bill, you'll run your car, you'll insure your life, you'll work from home, you cover family costs. Now, there's a better way of doing this, because if you do things this way, what's happening is you're paying yourself, HMRC is taking a cut, and then you're buying everything. That means you're buying your things with post-tax money. Let me turn this into an example. Let's say you want to buy the new iPhone, and the new iPhone is £1,000. Let's say you are a 40% taxpayer. In order for you to have £1,000 for you to be able to buy a phone, you will need to have earned about £1,600 because you go to take 40% off that to leave you with about £1,000 to then buy the phone. That is what we call paying for things with post-tax money. But if you have a limited company, there are quite a few examples of when you can pay for things with pre-tax money. So for example, that phone, even if it has some personal use, as long as you took it out in the business's name, you could have bought it through the company, therefore never needed to pull money out your company in the first place, which would have meant you could have bought the phone with pre-tax money, i.e. the phone will only have cost you the £1,000, which is the cost of the phone, as opposed to the £1,600, which is the cost of the phone, plus the tax you would have had to pay for drawing that money out. Now, not to go into much more detail on this, but also if your business was VAT registered, you'd also get a 20% discount because you could reclaim the VAT on the phone. Now, I'm going to give you a few examples of pre-tax and post-tax money. Then I'm going to move on to how you can pull money out of your limited company, salary, dividends, interest, so on and so forth. And then we'll go on to some of the more generic but easily missed tax tricks and ways you can pull money out of your limited company. So stay tuned for all of that. One way you can pull more money out of your company completely legally is by increasing the value of your director's loan. And by director's loan, I mean money that your company owes you, not money that you owe your company. This is in relation to personal expenses which you may pay for on behalf of your business. And there are also clever ways that you can do this, and I'll give you some examples right now. The first one is mileage. If you're using your personal car for genuine business journeys, visiting clients, going to meetings, going to sites, the company can reimburse you at HMRC rates. Notice I say HMRC rates and not reclaiming your petrol or diesel receipt, because there is a big difference. This is because if you use HMRC rates, you can reclaim 45p per mile for every mile you drive in your personal vehicle for work, as long as you meet the criteria, for the first 10,000 miles, and 25p per mile for every mile after. So let's put some numbers onto that. If you were to do 8,000 miles in a year, you times that by 45p per mile, and that'd be roughly £3,600 you can add on to your director's loan if you're using the HMRC rates instead of using the petrol receipts. Now, the reason we want to use the HMRC rates and not your petrol diesel receipts is because petrol and diesel receipts are just that, petrol and diesel. HMRC rates will also factor in your petrol and diesel costs, your car's depreciation, your wear and tear, and a few more bits as well. It's much more efficient to claim the HMRC rates than to put through those invoices and receipts. So remember now, we've increased our director's loan by £3,600 by putting through this mileage. Another way we can increase the director's loan, and I'll come and bring it all together in a moment, is by putting through costs for working from home. Again, HMRC will give you a flat rate of £312 per year. So if you work from home, you could reclaim £312 per year for working from home costs and add that onto your director's loan and pull that money out of your company tax-free in the future. What you could also do is be a bit more clever and use the apportionment method. This is a method where you claim a portion of your household bills, add it onto your director's loan to increase that money you can pull out in the future by the portion of the house that you use for business and the amount of time that you are in that room for. So you're looking at how much are your total bills for your heating, for your lighting, all the rest of it, and then work out what portion of that is attributable to the business and what portion of that is attributable to your personal use. There are a few more things that we can do to increase our director's loan. I won't go into that in too much more detail now, but now what I want you to think about is we have made adjustments to our director's loan, i.e. the amount of money that our business owes us. So we've increased it with the mileage, increased it from with working from home. Let's say that now equals £4,000 in total. You have been able to raise an adjustment in your company's accounts and so on and so forth. So you can now have this £4,000 which you can pull out of your business completely tax-free, because you're saying essentially, I incurred these costs on behalf of the business now owes me this money. So rather than you taking out an extra £4,000 in dividends, you just adjust your director's loan and then pull it out. Again, as long as you meet the criteria, completely legal. Now, another way that you can pull money out of your business, super obvious, bit boring, pensions. This one often gets ignored because it doesn't feel like your money because you can't really spend it right away. But it is super, super efficient. So I don't want it to be overlooked. Remember, you want to contribute through your limited company. That means you'll get the corporation tax relief. You'll also then have no income tax to pay on that and no national insurance to pay on that. So it is really valuable if you have that cash left over. The maximum amount that you can contribute to your pension through your limited company is 60 grand a year. So quite a lot of money you can put into that. Now let's come on to how you pay yourself, salary, dividends, so on and so forth. Now, there's often debate about should you be paying yourself just over 9 grand or just over £12,500 because of the employer's national insurance. We recommend to our clients that they're best to pay themselves a salary of £12,570 and not the £9,000 to avoid the national insurance for two reasons. First of all, you're going to want to probably pay that employer's national insurance because it's going to qualify you for a qualifying year for your state pension. So in the future, when you retire, you're going to get more money back from the government. It's probably going to be worth paying that amount of tax now to get more relief in the future. Also, if you employ more than one person for your business, so you and someone else, you're probably going to qualify for something called the employment allowance. So the other person in your business can be you and your partner, you and your children, you and a member of staff. When you qualify for the employment allowance, that national insurance that I just spoke about, the employer's national insurance, you'll be exempt from needing to pay that anyway. So we recommend our clients pay themselves £12,570 a year, employ someone else through their business. This way they can qualify for that state pension year, and they also won't even have to pay the national insurance that they were trying to avoid by paying themselves a lower salary. Once you've paid yourself that salary and used up all of your tax-free personal allowance, so right now this should all be tax-free, also fully deductible in your limited company, you're obviously then going to top up the rest of your income with dividends. Now, potentially, £500, this is going to be tax-free because of the dividend allowance, and typically you're going to want to increase your pay up to the £50,000. So you're making the most of the 8.75%, soon to be 10.75% dividend tax rates. So it's a really, really cheap and effective way for you to pull money out of your limited company. What you want to do after that, hopefully you've increased your director's loan, as we spoke about earlier, to pull more money out of your company, and hopefully you're purchasing certain assets through your business to, like the mobile phone, for example, to make the most of your pre-tax earnings, and anything left over, you don't want to be putting that into your pension. I'll come on to a few more bits now. There are a few nuanced things that people miss. First of all, you have trivial benefits. Every single director and employee can pay themselves in vouchers every single year, completely tax-free, okay? Your maximum amount you can pay yourself in vouchers is £300. You'll do it in 6 £50 installments throughout the year, completely tax-free. You can also take yourself and your employees, that could be your spouse, for example, out for a meal and put that through your company as well, completely tax-free. The limit £150 per head. Don't move by £1 because the full amount will be disallowable. Something else which is also worth considering is buying things through your limited company, even if there'll be some benefit in kind tax to pay on that. For example, private medical care. Private medical care is often significantly cheaper just for taking out a business plan as it is if you take out a personal plan. An example I have seen before is a company was able to get a medical cover for an individual for £1,200 per year through the company. If they were to do that individually, it was going to cost them £2,500, so more than double just to pay for it personally. Now they will need to pay benefit in kind tax on the £1,200 of benefit they've received. But even when you add the tax onto the medical care price, it's going to be much more efficient than you paid for that personally. Now, there are a few edge cases worth understanding. If you take a potential client out for a meal, the company can pay for that meal and you won't be taxed personally. Now, this won't be deductible from your corporation tax bill, but again, it's going to be a pre-tax expense. So it's still better than you paying for that personally. Also, if you do have a sufficiently large director's loan, it might be worth you charging interest on that loan. So if you loaned your company £100,000 to buy some equipment, to buy a building, you can charge interest on that loan. That interest will be deductible from your corporation tax bill. It'll also be exempt from national insurance, so it's going to be much more efficient, and you also will get access to these savings allowances as well, potentially, depending on your income level. So it's going to be a lot more efficient than you pulling that money out personally through a salary or a dividend, so on and so forth. The final thing I want to touch on with director's loan is how you can use them to be specific with the timing of your earnings. So just for ease, the £50,000 threshold when your tax rate goes from £20,000 to £40,000 is a really a hot point that we want to try and avoid going over. If you want to take out one year £50,000 out of your company, what you could do is take 50 grand out of salary and dividends, declare £5,000 as a director's loan, so you don't pay tax on that in this year. Then the following year, where your earnings may be less, you may pull out £45,000 of salary and dividends, and then the director's loan that you took out in the previous year, that 5 grand, you'd declare it in the following year as a dividend, meaning that £5,000 extra, you would never pay the 40% tax on it. You just pay the 20% tax on it a year later or a year earlier, depending on how you're wanting to work that. Now, I know there was a lot for us to go through in that video. The real takeaway from all of this is simple. Stop paying tax on money before you need to. If you're already paying for things personally, like running your car, using your phone, working from home, insuring your life, supporting your family, the question isn't whether there is some clever tax trick to avoid this. The real question is whether you're forcing those costs to be personal when they could go through the business, and you could be making the most of pre-tax spending rather than post-tax spending. You've also got your salary, your dividends, your employment allowance, your personal allowance, which is tax-free, your dividend allowance, which is tax-free, your savings allowance, which is tax-free, your benefits, which is tax-free, your staff parties, which are tax-free, so on and so forth. There's loads to go through in this video. If you want support with any of this and you're looking for help with accounting, bookkeeping, tax planning, of course you can contact me. I'll make sure my link is down in the description below. And if you found this video useful, please press like. I really appreciate it. It does take a while to put together these videos. And if you want to see more of this sort of stuff, hit the subscribe button, because I'd also love to see you in the next video. But that is all for now. Thank you for watching, and I'll see you next time.